Hello everybody, welcome back to our series of accounting. Today we are looking at the books of original entry and some transition from journal entries to the trial balance. So as usual, I've got my question on the board with some information on the board. I'll read each and every statement and try to make some explanations before we go to the working part. Okay, the first statement says receipts totaled to 111,202. 111,202. These receipts in accounting, they resemble sales. Okay, so looking at this statement, we can actually identify the two accounts which are involved. When we make sales, we debit money into the bank account. It means we put money into the bank account and our sales also increase. So the two accounts involved is the bank account and the sales account. Then we move to the next statement. Monthly rates of 14,000 was unpaid. It means we've accumulated an expense of 14,000 which we haven't paid. It means the rates owing account will be affected and the expenses will also be affected. We also go on to the third statement. Capital of 350,000 was invested. This means the capital account increased and also the bank account increased by the same amount. Okay, these are very large sum amounts of cash, and in accounting such sum of cash we don't put them in cash terms. We use the bank because we need to avoid money laundering. Okay, the next statement says the owner withdrew $4,000 for personal use. These are drawings, so we come and debit drawings and also credit the bank account where the money is coming from. Then you also have statement number 4. Pre-operating expenses amounted to 15,000. These are what we call preliminary expenses. These are not operating expenses and they are not deducted in the statement of profit or loss. So the pre-operating expenses, the company was maybe doing research or development, so they come as an asset rather than an expense. Okay, and the other account involved there is the bank account where the money was coming out from. We also have furniture valued at 22,000 which was transferred into the business, and this furniture is the first account that is affected. It's an asset that we will debit. We have an asset. Then the other part, the other value will go to capital. When an owner contributes an asset into the business, we actually debit the asset account, then credit the relevant amount, which is 22,000 here, to the capital account. Okay, then we move to statement number 6. Goods worth 10,000 were purchased and 25% of these were unsold. Okay, to go with this statement, we need to separate this statement so that we deal with each scenario alone. Okay, so goods worth 10,000 were purchased. On this statement, we go and debit purchases with 10,000. Okay, then we also credit the bank account where the money came from with a 10,000. Then on the second part, 25% of these goods were unsold. Now this 25%, it means we have some closing stock in our business. So we are going to debit closing stock, which is 25% of 10,000, and this gives us 2,500. we debit closing stock, then we also credit purchases. Okay, then we move to the last statement. 2 employees were paid salaries of 9,000 each. This means 2 by 9,000 gives us 18,000. So we are going to debit salaries with 18,000, then credit the bank with 18,000. Okay, now that we have explained these statements, now that everyone has understood these statements, we will need to do some journal entries. We need to do some journal entries and see what happens. Some journal entries and see what happens. Then from the journal entries, we'll also try to do the trial balance, which is supposed to balance. Whenever we do the things right in accounting, everything is supposed to balance. Okay, so let's start. Now I assume that everyone has paused and copied the question. Okay. Okay, I'll start with the first statement. The first statement was a statement of sales. Okay, so for the first statement, we say we are going to debit the bank and credit sales. The amount was 111,202. 111,202. Okay, that's the first statement. The first journal entry is there. The second journal entry is for this statement, which says monthly rates of 14,000 were unpaid. The monthly rates of 14,000 were unpaid. We said the two accounts involved there is the rates which accumulated to 14,000 and the rates accrued. The organization owes 14,000 to the authorities. Okay, then we go to the third statement, which says capital of 350,000 was invested. Capital of 350,000 was invested. Here we said the two accounts involved are the bank account and the capital account. The two accounts involved are the bank account and the capital account, which means we are going to debit bank with 350,000 and credit capital with 350,000 also. Okay, then we had another statement of drawings which says the owner withdrew 4,000 for personal use. Okay, I'm going to use that one. Drawings and bank are the two accounts involved. Okay, let me just wrap these ones and create some space. The owner withdrew 4,000, so it's now drawings. We are debiting drawings with 4,000 and we are crediting bank with 4,000. Then we move on. We move on to the statement number 4, which says there were preliminary expenses of 15,000. What we do here, we are going to debit preliminary expenses and credit bank account with the relevant amount, 15,000. Okay, that's it, and we move on to furniture. The owner contributed furniture worth 22,000. So furniture is an asset that we are going to be using in the business. So we debit furniture and credit capital. $22,000. Then we move on to purchases. There were purchases of 10,000, and we are going to debit purchases with 10,000 and credit the bank with the same amount. Then we are also told that there was 25% of these purchases which were left unsold, which means there was some closing stock. So what we are going to do, we are going to debit closing stock with 25% of 10,000, which is 2,500. And also credit purchases with the same amount. Okay. Now we also have salaries. Let me just create a space for salaries there on top. Salaries were paid, and they were 18,000. They were paid through the bank. Okay, now that we have done our journal entries, let's move on and try to move the figures that we obtained from journal entries into the trial balance, so that we come up with something that is balancing. Remember, the trial balance is based on the accounting equation, and it must balance. If it doesn't balance, it means we would have made an error somewhere, somehow, because we are supposed to do double entry when doing our records. So if there is no double entry, or if there is an error during the double entry, the trial balance won't balance. Okay, so the trial balance, let's just put it this way. I'll put this side as the debit side and this side is the credit side. So the first entry that we have into the trial balance, let's put the bank. Now the bank has been affected by quite a number of things, and some of these things, they include the cash the money that we obtained from sales. We obtained 111,202 from sales. We also obtained $350,000 from capital that was injected. Then the bank account also paid $15,000 in preliminary expenses. The bank account also paid $10,000 for purchases. The bank account also paid salaries for 2 employees, where we paid $9,000 for each employee, and this comes to $18,000. And we also have $4,000 which was withdrawn by the owner for personal use. So these are the transactions which moved within the bank account. And if we take our calculator and add these ones and deduct these ones, this is 15,000, 111,202 plus 35,000 plus 350,000 minus 15,000 minus 10,000 minus 18,000 minus 4,000, we come up with $414,202, and that's for the bank account. Okay, so that's the bank account on the debit side of the trial balance, because it is an asset. Okay, now we move to rates. We had an amount of rates. The rates, they were not paid, but they were accrued as expenditure. So we will list the 14,000 for the rates. We also have sales. We made sales of 111,202. Sales actually go on the credit side of the trial balance. Then we also have preliminary expenses. Preliminary expenses. These ones, they resemble an asset. So we are going to put them on the debit side of our trial balance. Okay, then we also move to furniture. We had furniture for 22,000, which is also an asset. We also had purchases. We purchased goods for 10,000, but we had 2,500 which remained in stock. So purchases will just write 7,500, and the other 2,500 goes to stock. Then we also have salaries. Salaries, we had 18,000. After salaries, we also had drawings. The owner withdrew money, so we also put drawings there on the debit side. Then we also have rates owing. Rates owing. The organization did not pay these rates, the 14,000 rates. So it goes on the credit side. It's an owing, it's a liability, it's a liability to the organization or to the business. Okay, we also have capital. Now, capital was also affected in a similar manner with the bank account. The first capital which we obtained, it was 350,000. But another asset was added. Another asset was added in form of furniture, which had the value of 22,000. And this furniture adds up to the capital. So this means 350,000 plus 22,000, we get 372,000 for our capital. Now everything has been put for the trial balance. Now we have to balance this book. We have to balance this account. So we make total for both the debit and the credit side. If there is no error, if there is no error and there's nothing which has been eliminated and there's nothing which has been omitted, this is supposed to balance. Okay, if we add this side 111,202 plus 14,000 plus 372,000, we are supposed to get 497,202. On the debit side again, if we add all this, we are supposed to come up with 497,202. And that means the trial balance would have balance.